Most traders can read charts, they can spot patterns, they can manage risk, they can even follow a solid plan. And still, they usually manage to lose money. Not because they're undisciplined, not because they need another strategy, but because they're usually missing the single force that actually moves the market: liquidity. So what if every stop out, every fake breakout, and every sharp reversal wasn't random, but part of a deliberate process happening behind the chart? Now today, we're unpacking the hidden mechanics behind price movement. And once you see it, you'll never look at a chart the same way again. Now every trader starts with the same playbook: patterns, indicators, market structure. We're taught that price reacts to levels, trends follow momentum, and breakouts confirm bias. But here's the truth few talk about. Price doesn't move because of patterns. It moves because large players like banks, funds, and huge institutions need liquidity to fill massive orders efficiently and without moving the market against themselves. Every participant, from hedge funds to high-frequency algorithms and even retail traders, leaves resting orders in the book. Now, when price moves, it's not institutions attacking retail, it's simply the market doing what it must do, moving to where enough liquidity exists for transactions to happen. That's why what looks like a breakout or a reversal is often just a liquidity event, a move engineered to access orders sitting beyond an obvious level. Retail education teaches people where to enter. Institutional mechanics teach how price fills orders. And those two worlds often collide. So when a major bank wants to buy hundreds of millions of Euro USD, they can't just open up their trading terminal and press the buy button. If they did that, it would cause instant slippage. Price would spike before their order even fills. So instead, they do something smarter. They accumulate quietly and they engineer liquidity. They accumulate slowly over time inside tight ranges, or what we call consolidation zones. They build exposure piece by piece. So what looks to the average trader like a consolidation period is actually orders getting absorbed. Large players feeding off the available liquidity while trying to keep the price stable until they build up their position. So that slow build-up creates what we usually call the accumulation zone. Now, once they've accumulated enough exposure, they still need more liquidity to finish filling their orders and initiate the larger directional move. So where does that come from? Well, from the clusters of resting orders sitting just above or just below an obvious range. Buy stops, sell stops, limit orders, and pending positions sitting there waiting to be triggered. That's where the liquidity sweep comes in. A sharp move beyond the key level designed not to manipulate, but to access the liquidity needed to complete those transactions efficiently. So by pushing price into those zones, they trigger stop losses and new breakout entries at the same time. Those orders create the volume institutions need to fill their own positions at the best possible price. So once the sweep collects enough volume, the real move is ready to begin. It's not personal, it's not manipulation, it's simply the mechanics of large order execution. So once you grasp that, you stop blaming the market and you start to understand it. So liquidity builds wherever the market finds agreement, at swing highs, daily lows, previous session extremes, or clear technical levels. Each stop loss, each pending order, each breakout order adds to that liquidity pool. Because traders tend to act in clusters, those areas become magnets for price. So think of liquidity as fuel. The market can't move very far without it. So price gravitates towards these zones, sweeps through them, collects the orders, and then, once the fuel is absorbed, moves decisively in the intended direction. I'm sure you've seen it 1,000 times. A perfect setup, a spike through a level, and then a sudden reversal. That's not random, that's a collection event. Price clearing out orders before expanding in the opposite direction. That's why you'll often see wicks, spikes, and sharp reversals around obvious levels. And the higher the time frame of the event, the deeper the liquidity and the larger the move that usually follows. So this is where traders usually get trapped. You see a breakout forming, momentum looks strong, and you enter. And then instantly, price reverses and stops you out. So you think you were wrong, you think your timing was off, but what really happened is that you entered before the liquidity sweep instead of after it. So the market needed your stop to fill the large orders. Now once that process is complete, the real move begins without you. It's not an attack, it's structure. The market moves where orders sit, not where you want it to go. Now here's the twist. The market is structured to make you feel right just before it proves you wrong. That emotional reaction, that frustration, disbelief is what keeps this cycle going. So when traders react emotionally, they become liquidity. Now when traders wait for confirmation after the liquidity sweep, they position themselves with the flow of the market. That's the psychological divide between retail and professional behavior. So how to read the liquidity sweep in real time? Well, let's break it down into something practical. Step 1, identify the possible liquidity pools. So we go on our chart and we mark the obvious high, lows, prior session extremes, key swing levels, and clean structure points. So ask yourself, where are most stop losses right now currently sitting? That's where liquidity is most likely building up. Step 2, you watch for the accumulation before the sweep. So before a sweep, price often consolidates. That's quiet accumulation, large players building exposure without tipping the market. Now the longer the accumulation goes on, the more significant the liquidity resting just beyond that point. And step 3 is the sweep. You'll see a sharp move that pierces the liquidity zone. It's usually fast, aggressive, emotional. It triggers stop losses and pending orders, generating liquidity needed for execution of those large orders. So watch for strong wicks or high volume rejection candles. And step 4, confirmation after the liquidity sweep. So you wait for a structure shift or momentum reversal after the sweep has taken place. It's a signal that liquidity has been taken and possibly the true move is just starting. Now once liquidity has been collected on one side, price often moves towards the next major liquidity pool on the other side of the market. That gives you your directional bias. So this kind of process repeats across all time frames. But remember, not every move is a liquidity sweep. However, before major market shifts, a sweep almost always occurs. That's why the best trades happen after the liquidity sweep, not before it. Markets look chaotic when you zoom in and watch them candle by candle. But when you zoom out, there's a repeating rhythm in the market. Build up, collection of that liquidity, and then distribute. So liquidity builds where traders usually agree on their stop losses or on their new pending orders. Now liquidity is collected when those levels are breached, then price distributes in the direction of the true intent. That's the engine driving major market movements. Now this concept isn't unique to Forex. It happens in stocks, crypto, commodities, in all kinds of markets. Different players, same mechanics. So the market isn't random, it's cyclical. And once you start seeing these cycles, you stop fighting the noise and start trading the structure beneath it. So many traders think more tools in their analysis means more controls. So they stack different kind of indicators, whether it's Fibonacci levels, Elliott waves, chasing for the perfect analysis. But complexity doesn't create clarity. Often it hides it. So markets aren't driven by indicators. They're driven by liquidity necessity. Every technical tool can be useful, but only within the context of liquidity. So without understanding why price moved, analysis is more like decoration, not insight. The pros don't chase perfect signals. They wait for liquidity to be taken, then act with mechanical precision. Simple, repeatable, and aligned with the mechanics of how the market actually works. So every trading session is a smaller version of the same cycle, even if we look at it through the lens of intraday trading. The Asian session usually has a consolidation, where it's building up liquidity pools. London usually sweeps those ranges and sets the intraday bias. And then when New York opens, it expands or reverses on that London move depending on where the higher timeframe liquidity lies. And the same pattern repeats across different timeframes. Daily sweeps fuel the intraday trends, weekly sweeps shape the large swing moves, and monthly liquidity grabs often anchor the long-term direction. So the higher the time frame of the sweep, the deeper the liquidity, and the larger the move that follows. When smaller time frame sweeps align with larger time frame ones, that's when the cleanest moves unfold. Now that's not coincidence, that's confluence through liquidity. That's why understanding liquidity context matters more than any single kind of setup. Liquidity-based trading is about patience, not prediction. You're not trying to catch everything. You're waiting for the market to show you its hand. Now, patience is the most underrated trading skill because it keeps you out of low probability noise. When you wait for liquidity to be collected, you're trading with confirmation, not with hope. And that's why simplicity outperforms speed. The market rewards discipline, not constant activity. It's mechanical, it's repeatable, and it's the opposite of what most traders do. So most traders operate on the surface. They draw patterns, mark support, identify trends, which are all valid tools, but they use these tools without understanding what fuels these moves behind the chart. So liquidity mechanics run deeper. They explain why certain setups fail and why others work. So most traders never learn about this layer. It's not about institutions hunting retail, it's about the market fulfilling its purpose, moving towards areas where orders can execute efficiently. So once you understand that, you stop fighting the flow and you start following it. Now, retail methods teach you where to place stops. Liquidity understanding teaches you where stops will be taken and why. So one keeps you as liquidity and the other aligns you with it. So the next time you open a chart, don't look for a pattern, look for intent. So ask yourself, where is liquidity likely building? What liquidity might the market need next? And what direction tends to follow once that liquidity is taken? So when you start thinking in this way, the market stops feeling random. You begin to recognize the rhythm behind major moves, not because you're predicting what the market's going to do, but because you're aligned with how the system actually functions. So liquidity isn't a strategy, it's the context. It's the missing layer that makes your existing strategy make sense. Now, once you understand liquidity, you expect the stop hunts, you anticipate the liquidity sweeps, and you wait for confirmation instead of chasing setups in random areas of the chart. Because trading stops being about guessing and starts becoming about aligning with the necessity of the market. That mindset, which is calm, mechanical, and patient, is what separates consistent traders from the crowd who is still reacting to randomness. So liquidity isn't just another concept, it's the engine of every market. Every accumulation, every breakout, every reversal begins and ends with liquidity. So once you understand how it forms, why it's collected, and how to trade after the process completes, consistency stops being about luck and starts becoming about structure. So think back to your last losing trade. Did price take out your stop loss and then reverse? So go check on the chart and check if it was a liquidity sweep. Let me know in the comments, and if you want to go deeper into these kind of mechanics, subscribe to the channel for more updates.